All right. So welcome back to the lecture on determining interest rate. So far we've talked about how money is supplied into the economy, the main determinants of money supply in the economy. So as we laid out in the framework for the course, we started first with a discussion about money. Then we talked about how bonds are priced in the economy and how do we determine the yields on these bonds. And now the question turns to how do we determine the interest rates in the economy, right? So there's four key ideas that we like to discuss in this session. The first thing is to talk about what important factors are involved in building an investment portfolio, right? So what we're trying to achieve here with this course in money banking and the financial system is to get a basic understanding of all the component systems of the financial system, which begins first of all to understand what the units of the financial system are, and then how do we bring them together into a portfolio which makes sense, right? So we'll talk about some important factors in building an investment portfolio, and then we'll step into some of the most crucial elements of this course, where we'll talk about how we determine interest rates for bonds using two different models, right? So we'll first use a demand and supply model to determine market interest rates for bonds, and then we will talk about how interest rates are determined using the money market model. So there's two separate models that we generally consider in determining interest rates, and we'll take each of those in turn and go into a deep discussion of this. Okay. But the question, as always, we start with a motivating issue so that it ties it into the real world. Why do we even care about interest rates, right? So if you look at what's happening right now, interest rates have stayed low in the aftermath of the financial crisis of 2007 to 2009. This central bank decided to cut interest rates as much as possible. They reached the zero lower bound, and then they went on to do other programs that we discussed as quantitative easing, right, where they stepped in directly into asset markets and made purchases. Okay? So why do we care so much about these interest rates? And the straightforward explanation should be intuitive. If interest rates are very low, that means that access to credit is very cheap, right? So when to credit is much cheaper, firms and households might be incentivized to borrow a little bit more and engage in economic activity, right? So when the going gets tough, when the economy hits a bump and it goes into a recession, the standard issue macroeconomics handbook will tell you that the central bankers should try to cut the interest rates as much as possible. So by easing the credit constraints in the economy, you try to spur on more economic activity and rebound from the recession. And that's basically what the central bank, the Federal Reserve, did in the aftermath of the 2007-2009 crisis. But what's strange is that interest rates have remained at historically low levels for a very long period of time, right? For over a decade, we've seen a climate of very low interest rates. So I went and looked up what the interest rate on a one-year certificate of deposit at a leading American bank is. So if you look at what Wells Fargo will pay out on a one-year deposit, it's about 0.15%. Historically, these numbers have been as high as 6.5, 7, 8%. That's going back to the 80s, but they've dropped off a lot over the preceding decades. But this is a precipitous drop, right? Where on the eve of the crisis, you could still get 3-4% interest rates on these kinds of instruments. Now the interest rates are under 1%, right? And if you think about if you remember the argument around the Fisher, um, around Irving Fisher's idea that there is something called the real interest rate and the nominal interest rate. The real interest rate tells us how much whatever you're earning in interest is in terms of purchasing power. So it's the nominal interest rate adjusted for inflation. So if you're getting 0.15% as a nominal interest rate on your deposit, and the inflation ends up to be about 2% in the economy, in real terms your purchasing power is going down over time, right? Because an inflation rate of about 2% in the economy indicates that all the goods and services that you want to buy in the economy are getting more expensive by about 2% a year, but your wealth is only growing at 0.15% per year. So the purchasing power of all your savings is going down over time, right? And the question becomes, First of all, why are interest rates so low? We've already touched upon that for for a bit, but we'll go into it in more detail as the course progresses. And the second thing is that it gives us an indication of why we care about interest rates to begin with, right? Why we care what the interest rate level is. And then the third question becomes, how do we determine what the interest rates should be in the bond market? Okay? So the key question that we are trying to address over this course of this particular discussion is to ask what factors are important in determining interest rates. How is an interest rate determined? Okay. So before we get into all of that, we'll first begin with a brief discussion about portfolio choice, right? So when we talk about a portfolio, we're generally talking about just a collection of financial assets. You can put together a variety of bonds and stocks and other kind of exotic instruments like real estate investments or alternative investments and so on and so forth. You're essentially trying to decide how to distribute your wealth that is available to you among the different asset classes that are uh, being traded in the economy, right? So we'll talk about what determines what goes into the portfolio of a particular individual, right? So we'll five key determinants that we want to talk about. The first thing is how much money does the investor have to invest, right? So that's what we call wealth. The second thing is that we want to know what is the differences between these different assets. So if do I invest in stocks or do I invest in bonds? The question then becomes, what is the return on stocks and what is the return on bonds? I'll make my distribution based on what is the risk return profile of one particular asset class versus the risk return profile of a different asset class. So I need to know not only the expected rates of returns for different investments, but I also need to know what is the degree of risk involved in each of these different instruments. Okay? Then there might be a consideration of liquidity, right? So if I invest in a particular asset, how how easily can I turn it into hard cash, right? If I need that money on a very quick basis, the liquidity of the asset might be important, right? And so that's the fourth consideration in determining portfolio choice as to what is your liquidity constraints. And finally, there is a notion of about information costs, right? These are what we might also call transaction costs, but these are information costs because you have to spend a lot of time trying to look at, this over 3,500 listed equities on the US stock market. And so if you're trying to put together an equity portfolio where you're just choosing stocks, now we have 3,500 different companies to choose from. It takes an enormous amount of time and research to look through each of these companies, do a competitive analysis, understand the core business, understand what the trends for the future look like before you can make an informed decision on whether to include a particular company in the portfolio or not. So the fifth thing is that there is a bias towards investing in well-covered stocks. Everyone holds a FANG stock portfolio as a bare minimum, right? Like the big tech names, right? And then they start to add more and more companies into it. So as the cost of acquiring information goes up, it becomes more cumbersome to include a particular equity and do all of that research into your portfolio and so on and so forth. So those are the five key things. How much money do you have? What are the expected returns for the different assets? How much risk do I need to carry to invest in each of these different assets? What is my liquidity constraint? Do I value the ability to turn these assets into cash on a short order basis? And what are the information costs associated with putting together these portfolios? Okay. So we'll take each of those determinants in turn and take a look at what happens. So wealth is the most easily accessible notion here. So wealth of an individual is basically determined as assets minus liabilities, what you own minus what you owe, right? All the financial claims that you have on different entities versus all the financial claims that different entities have. You The difference between those two is what we end up calling wealth, right? So it's assets that a person owns minus the total value of any liabilities that the person owes, right? Generally speaking, it's intuitive that as wealth goes up, so we are interested in doing some kind of a comparative statics discussion here. So what happens if there's a change in wealth? So it's intuitive that as a person grows wealthier, the quantity demanded for most financial assets goes up, right? As you get wealthier, you have more money to invest. You want your demand for financial assets starts to go. So that's the first key determinant of portfolio choice that we need to consider. The second thing is the expected rate of return, okay, on different financial assets. So when we talk about expected rate, the rate of return here is a straightforward idea. So if I invest $1,000 in something, and if I get back $1,100 from that investment, I know that I've received a 10% rate of return. Okay. Now the term expected comes into this picture because there is uncertainty around what rate of return I might get, right? So here's the situation that I've charted out. So suppose I buy a bond which has a face value of $1,000, right? So the face value is $1,000 and it has a coupon rate of 8%. So every year that I own that bond, I get a coupon which I can clip and I get an 8% return. So I get $80 on that bond as a coupon payment every single year. Okay. So, but this bond that I have is not just in stasis, it is trading on the bond market. So the price of the bond itself might fluctuate. We've talked about how the price of the bond moves around, but suppose there is a possibility. So I buy an IBM bond. So IBM owes me money, and suppose there's two possibilities. In the first rosy case scenario, the bond price actually appreciates, right? So from $1,000, now it's worth $1,016.50, right? Because a lot more people are interested in buying this IBM bond, so the price of the bond goes up. And I have a based on this, if you do this calculation, 1650 over 1,000 is a 7% capital gain, right? So there's a price appreciation of the asset that I own of 7%. So the total return that I get for the year is that I earn the coupon rate of 8%. I realize a capital gains of 7%. So the total rate of return that I have here is 15%. So in one possible scenario where there's a lot of demand for this particular bond, there might be a capital gain and I can get a return of 15%. Now, the second possibility is that suppose some bad news happens, right? The IBM earnings come in lower than what you are estimating, whatever it is, and there's a decline in the demand for this IBM bonds. That might crash the price because as soon as demand falls, a basic supply and demand tells you that if there's an increase in demand and the supply is held constant, the price needs to move up. If there's a decrease in demand with supply held constant, then the price needs to come down. Suppose the price falls to $921.50, and that's about a 3% capital loss, right? Because you bought it for $1,000, now it's worth only $921.50. So if you sell it on the market today, you realize a capital loss of negative 3% because of the price depreciation. You still get your 8% coupon rate, but the price of the bond has gone down by 3%. So the total return for the year that you might earn is 5%. So in one state of the world, in one possibility, you might get a 15% return. In another state of the world, you might get 5% rate of return. And this is the inherent uncertainty around these financial assets because no one can predict exactly what the rate of return will be. We don't know ahead of time whether we'll be in possibility one or we will be in possibility two. Right? This is impossible to determine ahead of time. That's what we in the next few slides we'll discuss as risk. But it's impossible to determine which of these possibilities we can. But we can talk about expected returns where we think about what happens on average, right? And that depends on what is the probability, right? What is the likelihood that I end up in this state of the world in possibility one versus what is the probability that I end up in this state of the world possibility two, right? Suppose take the simplest case where there's an equal probability, right? There's a 50% chance that you might end up in a state of the world where the bond price goes up, right? You get all these good news, the price of the bond appreciates, you realize there's capital gains, and you end up with a 15% return. And there's a 50% chance, it's a coin flip, there's a 50% chance that you might end up in this state of the world. You bought it for $1,000, the price went down to $921.50. You realize the capital loss, and the total return that you get for the year is 5%. So on average, if you think about what the return is going to be, it's going to be 50% of the time. So it's the probability of event one occurring. When we calculate expected returns, is the probability of the event occurring times the payoff I receive if that event happens. Okay, so there's a 50% chance that I'll end up with a 15% return, and then there is a 50% chance that I end up with a 5% return, right? So on average, I would end up with 10% return, right? The point here to clearly understand is that there is never going to be a day where I will earn a 10% return, right? Either I'll earn 15% for the year or I'll earn 5% for the year. But if I stay invested in this for long enough, sometimes I'll earn 50%, 15%, right? That's about 50% of the time that I'm invested in this product, I see a 15% return. About 50% of the years that I'm invested in this product, I see a 5% return, which means that on average, if I blend those two together, on average, on any typical year, I end up with an average return of 10%, right? And that's what we call the expected return. Okay? And that gives us an indication of um, how valuable a particular asset is, or um, uh, how attractive a particular instrument is. Okay, so that's the second thing that we need to know in determining the portfolio choice is what is the expected rate of return on different assets, and so we can start to compare between different assets. So if one asset has an expected return of 10% and another asset has an expected return of 12%, you might think that, yeah, I go with the asset with the higher expected return because I earn more money on average by investing in that asset. But that's not the complete story, because what's missing in that story is this notion of risk, right? How much uncertainty is there is around each asset is what we call risk, right? So the what we find, at least in empirical literature, in the academic literature, is that most investors are risk averse, right? So when we show investors two assets which have the same expected returns, right? Investors tend to choose the asset which has a lower risk profile. It's not that they're indifferent between the two assets. The point I'm trying to get to is that if I show you two assets where both assets will earn the same expected return, 10% on asset one, 10% on asset two, the the story doesn't end there where you're like, okay, I go with asset one or asset two, it doesn't matter, I'm indifferent between those two. But that's not what we find when people are shown these two choices. But if one asset is riskier than the other, people tend to choose the asset with the lower risk level. So there is a risk preference also built into it, and most investors tend to be risk averse. Okay. You sometimes will find, most investors are risk averse, but not all. You will find some risk loving investors who prefer to hold risky assets. They are able to tolerate a higher degree of risk because if it comes with the anticipation that there's a higher degree of returns, right? So, your typical venture capital private equity funds are operating on this business model because a lot of their investments are going to go bust, right? Venture capital is notoriously difficult to judge a small startup idea as to whether it'll be $1 billion idea or $1 trillion idea when all you have is a germ of an idea and a skeleton crew trying to get this idea off the ground. It's really difficult to judge whether an idea will take off or not. So venture capital firms distribute their wealth among a lot of different ideas, and a huge proportion of them go bust, right? A lot of these ideas never take off, or they might receive some funding and then they fall short in execution, whatever happens. But the overwhelming majority of these investments don't pay off. But there might be one or two investments which pay off on a huge multiple, right? And so you will see investors who are risk loving, who are able to tolerate this huge amount of volatility, who are able to tolerate a lot of risk in the hope of maximizing expected returns. Okay. There is a concept of risk neutrality, right? This is more or less a theoretical construct. So we know most investors are risk averse. We understand that some are risk loving, but we want to know a perfectly sage investor, risk neutral investor. Risk neutral investor, as the name suggests, is neutral to risk. So they don't really care about risk, right? They don't ignore risk completely out of the equation. All they care about is expected returns. So you tell me that one asset has an expected return of 15%, one asset has an expected return of 10%. A risk averse individual is going to ask, what is the risk involved in the 15% return asset? What is the risk involved in the 10% return asset? And choose the asset with the lower risk. A risk-loving individual is going to just, will not tolerate high amounts of risk, yeah, as long as the return is sufficiently high enough. A risk-neutral investor is not going to care about risk. They're not going to bother asking the question, is one asset riskier than the other? All they care about is the headline number, the expected return. Okay, so they're always going to end up in that situation, choosing the higher asset with the higher expected return, ignoring completely what the risk profile is. And we will never really find like investors like this. Risk neutrality is more or less a theoretical construct, but it gives us a baseline of analysis. Right? Starting from the notion of risk neutrality, then we can complicate the models to include risk averse, risk neutral, risk averse, and risk loving individuals. Okay, so here's some data on this. Okay, so suppose you are in this business and there's these different asset classes you can invest in, right? So small company stocks, small, when we're talking about small, we're talking about in terms of market capitalization, the size of the company on the stock market. So if you look at the historical return of small company stocks, they have a 12% return on average, right? When you compare that to large company stocks, on average they return only 10%. So and the intuitive explanation for this is very, very straightforward, right? When you go from 1 to 2, right, when you go from a turnover of $1 million to $2 million, that's a 50% increase in revenues, right? Because you added basically sorry, 100% increase in revenues, because you went from 1 million to 2 million, you doubled your revenues. That's a 100% increase in revenues. But if you're already $100 million company and you add $1 million worth of revenues, now that represents only a 1% increase in revenue, right? So the point I'm trying to make is that it gets much larger and much more difficult to generate huge changes in revenue at scale. When you're already a massive company, the returns that you're going to be able to earn is not going to be that significant. So small companies grow a lot more rapidly because they have a lot more room for growth, right? The runway of growth is there's right at the beginning of that runway, so there's a lot of room to run up. But if you're already a fairly mature company, right, you've been in business for 40, 50 years and you know your business inside and out, and you've basically looked at every corner of your business, and um, you've done all the got rid of all the inefficiencies and redundancies that you can. Now you have a lean business which is running at peak. It's very difficult to improve on that business furthermore, right? So you can see that small companies, large company stocks on average return less than small company stocks. But and looking at just this, it seems to suggest that there's an obvious portfolio choice mechanism here. Okay, so maybe I shouldn't ever buy large company stocks because they only give me 10% returns on average. There is another investment class that I have, small company stocks, which give me 12% returns on average. But that's not the end of the story, because the other part of the story is to see the risk involved. The risk here is measured as a standard deviation that we've already alluded to of these uh, uh, classes. But here the risk on the small company stock, there's a lot more volatility. So this number represents how much volatility there is in the stock. The higher this number is, the more volatility there is in the stock prices. So here the volatility is 23% in small company stocks versus 17.4% in large company stocks. So now the question is, am I willing to tolerate this extra volatility in order to get 2% extra returns? And the question then comes down to the risk appetite of the investor, right? If you're a risk averse investor, you might say, no, I don't think this makes that much sense. I might take on a small allocation of small company stocks, but I'm not going to just invest all in small company stocks. Mostly I'll be investing in large company stocks, and then I will add in a few small companies into it just to get some exposure to the higher return profile of the small company stocks, even though it gets a little bit more risky. Okay, and then as you can tell, bonds generally pay out much lower. So on average you can earn 5.6% on long-term treasury bonds, but they're also much less volatile, right? The risk is much lower. And government bonds, US treasury bills, as you can tell, have the lowest return, 3.4% on average, but they also have the lowest risk of 3.4%. And here you can see straight away that there is a positive correlation between risk and return. Yeah. So if you take a course in financial economics, that is one key element of it. In portfolio selection choice is this trade-off between risk and return, and there's a positive correlation, which is to say, if you want a higher return, you might have to tolerate higher risk. If you are willing to settle for a lower return, you might get away with being at a lower risk level. And the entire art and science of putting together a portfolio depends on how we trade these things off, right? Is a 3% extra return worth of 7% increase in risk level? Is that trade-off fair or not? And how do we mathematically model those things? That's what we do in a course in asset pricing in financial economics. So, but which is completely beyond the scope of an introductory course in money banking and financial system. But I just want to give you a brief overview of what comes next. What do I do with this information? That's what we do next. Okay. All right. So the last two elements of portfolio choice are, we talked about liquidity and cost of acquiring information. So liquidity, the more liquid the asset is, the more desirable it is to investors because it's easily convertible to cash, right? If there's two assets, one which returns 10%, the other which returns 10%, one I can buy and sell on the market on any given day. If I need the cash immediately, I can just go into my stock portfolio, sell the asset, get the money, I'm off to the races. And the second asset is some abatement building, which takes, I don't know, 5 years before I can get my money back. Even though the rate of return is the same, I might prefer the stock over the property in that sense, right? So that's basically what we call the liquidity consideration, the liquidity constraints. And the more liquid a particular asset is, the more attractive it is. And that's fairly intuitive and straightforward. Okay. Finally, the cost of acquiring information, of course, in a implicit sense, the more difficult it is to value a stock, the less desirable it becomes. Because if it's a very hard to understand business and the financial statements are not very clear, you don't understand the business model all that well, it takes a lot of effort to get your head around that business and to accurately value it and then decide whether to invest in it or not. It takes up a lot of human resources to do all of that. So generally speaking, all else being equal, investors will accept a lower return on asset that has a lower cost of acquiring information, because the cost of acquiring information is going to eat into the returns that you might get from the asset, right? So if there is an asset which uh, there's a possibility that the asset will double your money, so there's 100% return option. But suppose it costs you, you have to hire analysts and they're looking through all of this, and it takes months and months of paying them salaries in order for them to come up with a analysis. And after all of that, suppose you might only end up earning an 8% return versus just investing in a broad portfolio of large company stocks, which will get you a 10% return anyway. So the point is that the return itself is not uh, the return is the starting point, is not the end point, right? You start with looking at the return of an asset, adjust that return based on the level of risk that the asset carries, then adjust that further by the cost of acquiring information, and adjust that further down by how much liquidity that the asset has. So you need to take into account all these other characteristics of that asset before you can make an informed portfolio choice. Okay. And so here there's a quick little table which tells you what should happen in each of these cases. So an increase in wealth should increase the demand for financial assets, right? Quantity demand of the asset in the portfolio should rise because investors have more savings. You're wealthier, you demand more financial assets. Expected return on asset relative to the expected returns on other assets, if that goes up, if there's an increase in the expected return of one asset relative to all other assets, you expect to see an increase in the quantity demand of that asset. Okay. If the risk goes up, the demand for that asset goes down. If liquidity goes up, that should increase the demand for that asset, and information costs go up, then it should decrease the demand for that asset, right? And this is just a quick summary of what we've been discussing already, so this should be fairly straightforward, hopefully. Okay. The last thing I want to talk about in this section is on this notion of diversification. Okay. Diversification, it might seem like one of those words that gets, you see it everywhere, might not fully understand it, but it just as a simple enough thing that is, comes from the old adage that you don't put all your eggs in one basket, right? So if that one basket falls, then basically you fall with it. All your eggs are broken and you have nothing to show for it. So you distribute the available wealth that you have among a variety of different asset classes to tamp down the level of risk that you're carrying in the portfolio. Okay. So again, in a more technical course in asset pricing, we can show this with the proper formal proof that there are gains to be had from diversification. But in an introductory class, the crucial element is to think about is that uh, the reason why portfolio choice is so important is that because we are trying to diversify away from holding what we call idiosyncratic risk, right? So we don't want to carry the risk of just living and dying by the fortunes of one company that we are wholly invested in. Right? If you're a proprietorship or a family-owned business, that's basically what you're doing, because most of the equity of your family, most of the equity that you have is tied up in that family business. And if that business fails, then basically you're wiped out as well. On the other hand, there is this broad plethora of financial assets which are available, these varieties of bonds and stocks and whatever have you that are available to you. So if you're able to put together your portfolio using, you invest a bit of money in this company, a bit of money in that company, a bit of money in the third company, a bit of money in debt, and so on and so forth. You do all of these things, what you're trying to achieve is that if one of these companies goes down, you don't get wiped out with it. You lose that portion of the portfolio, that's a write down, but the rest of your money is still intact and is still in play, right? So you can you can make portfolio choices and diversify away from idiosyncratic risk, but you can't avoid risk altogether, right? Because there's still market risk, right? So all these companies are still trading in the same market. So if the entire market collapses, right? So in your head, if you can imagine that, okay, think of it as a physical location, and then you can extrapolate the story. So there's a physical market, there's 20 stores in that market, you own one of those stores, and instead of just putting all of your money in your own store, you take some of your money and invest a little bit in each of those other 19 stores who are in the market. So this way you're diversifying away from the inherent idiosyncratic risk of your own firm, and spreading your bets a little bit wider. But suppose there is an earthquake and the entire market gets wiped out. Not only does your company go under, but also all the other 19 companies that you invested go under all at the same time. That is market risk, right? There is a probability that the entire market can collapse, and you can't diversify away from that risk, because where do you diversify? Okay. And this notion of that has given rise to, and that's why most sophisticated investors will not just be concentrated in one geographic location. You just don't hold US equities, you have some exposure to European equities, to developing market equities, to bonds from emerging markets, so on and so forth. You try to put some money in real estate, put some money in alternative investments. I don't know, you can do a variety of things, but the point is to get away from this just exposure to idiosyncratic risk, and carry as little market risk as possible. Okay. All right. So those are the 5 determinants of portfolio choice: the level of wealth that the investor has, the expected return on different asset classes, the level of risk associated with these expected returns, the amount of liquidity which is built into that asset, and the cost of acquiring information about an asset. Okay. All right. So now that we've done all of that, that was just a quick overview of portfolio choice. A portfolio choice theory is very complicated and it's very interesting, but for our purposes in this course, it's we just basically introducing this idea. And in a later course, if you can go on to take advanced electives in asset pricing or financial economics, you'll see in more detail as to how we make these portfolio choices. Okay. All right. So the next thing that we need to turn to here is to ask, how are the interest rates on a bond determined? Okay, how are the interest rates on bond determined? And the first model that we'll employ to understand interest rates on bonds is a fairly straightforward model of supply and demand. Okay, so let's now turn to a demand and supply model to determine market interest rates for bonds. Okay. So before we go into that, let's start with a quick recap, right? Now, when we talked about bond pricing, we began with this notion of this bond pricing equation. So the price of a bond, the fair price of a bond, is the discounted present value of its future cash flows. So if you buy a bond, the bond will issue these coupons, and then in this last period, when it's about mature, will pay off its face value as well in a bullet payment, and the discounted value of these cash flows, which appear at different points in time, is going to determine what the present value or the price of this bond should be, right? So if you think about it, the coupon payment is determined, right? When you buy the bond, there is a promised coupon payment, and that's not going to change. So C here is constant, FV here is constant, the face value of the bond doesn't change. So once we know the price in the bond market, we can back out what I is, because we know all the inputs in this. So the how do you know what the I here, the interest rate on this bond is to basically plug everything into this equation and solve for I, because you know the bond price, you can observe the bond price in the market at any given point in time. The coupon payments that the bond makes, those are held constant. The face value of the bond is constant. So if you can back out I from this equation, you know what the equilibrium I should be. Okay. So there's two competing models for how to think about these bonds, right? The bond market approach basically is useful when we are considering factors that affect the demand and supply of bonds, right? If the demand and supply of these bonds move, then the price of the bond moves, and if the price of the bond moves, then the interest rate is going to change. And that's how we essentially channel figuring out what the equilibrium interest rate is in response to changes in demand and supply for these bonds. The other uh, uh, model that we employ is to think about demand and supply for funds, right? Instead of using bonds as a good, where people are buying bonds as a good, we are thinking about funds as the good, right? This is what we call the market for loanable funds approach, where we are looking at what is changing fund flows, what is changing flows of money in and out of these instruments, and how they affect the bond price, and in turn how they affect the interest rate. But the crucial thing that I want to impress upon you is that when the demand or supply changes, the price changes. If the price changes, the I will change. That's basically how we pin down what the interest rate should be. In response to changes in demand and supply and the resulting price change, what is the effect on I, on the equilibrium I, which clears this bond pricing equation? Okay. And to understand that, we start with a fairly straightforward story. You've all seen supply and demand before, and that's basically what we have here, right? On the x-axis, we are measuring the quantity of bonds in billions of dollars. On the y-axis, we are measuring the price of bonds, P here, okay? Now, as we know, price and quantity are inversely related on the demand side. So if the price of the bond is really high, the quantity demand of the bond is going to be quite low. And if the price of the bond is really low, then the demand for the bond is really high. Okay, so we have this inverse relationship between price and quantity on the demand side of this bond market. On the supply side, we have a positive relationship between price and quantity of bonds. So if the price of the bond is really high, then the quantity supplied of the bond is going to be quite high. And if the price of the bond is really low, then the quantity supplied of the bond is going to be really low, right? So here we are treating the bonds as any other good in the economy, right? There is a market for that. There's a demand side of the market. There's a supply side of the market. And based on changes to supply and demand, we can determine what the equilibrium interest rate is. The equilibrium interest rate, equilibrium price for this bond is going to be where quantity supplied is equal to quantity demanded, which is a point of intersection between these two lines, which is right there. Okay, so in equilibrium in this market, there'll be about $500 billion worth of these bonds sold at a price of $960. So now that you know the bond price, which clears the market, so now that we know P, we know C and FV already, so we can back out what I will be. And if you back out what I should be here, it's about 4.2%. Okay, so that's basically the mechanical aspects of it. Okay. I hope that makes complete sense, because here we're treating the bond as a good. There's a demand for bonds, there's a supply for bonds. The intersection of the demand and supply determines equilibrium in the market. And at that equilibrium, we know the quantity of bonds demanded and supplied, but we also know the price at which each of these bonds is bought or sold in the market. If we know the price of this bond, we can determine what the equilibrium interest rate is, which determines this market. This is a next step, but they're simultaneously determined. If you know the price, I immediately. If you know I, you know the price immediately. Both of those are simultaneously determined in this market. Okay. Now, the usual mechanics of supply and demand are operational. So, if you're wondering, one quick thing, if you're wondering what where this 4.2% comes from, we are assuming that it's $1,000 face value bond which is maturing in 1 year, right? Okay. Right. So a 1 year discount bond, which has a face value of $1,000, is being sold at $960 today. So what is the yield on that? So you can just plug it in, but like you can straight away see that it's like, if it'll pay off $1,000 in 1 year and I can buy it for 960, the difference is 40 over 960, which is 4.2%. That is the interest rate that I get on that bond. Right. That's where I'm getting the 4.2% number. Okay. All right. The other thing is that the usual supply and demand dynamics, which govern most markets, govern the bond market as well. Okay. So what does it mean? So what happens? So E here represents the equilibrium in this bond market. So what happens if the price of the bond is higher than $960? Suppose it's at $980. So at $980, the quantity demanded of this bonds is, say, here at B. The quantity supplied of the bonds here is at C, right? Here we have excess supply of bonds, right? At this price, there's not enough people who want this bond, who want to buy this bond at $980. And but there's a lot of people who would like to sell this bond at $980. Okay. So here we have an excess supply of bonds, and straight away you can think, okay, if there's excess supply, if there's more people are willing to sell than buy, as a seller, what is my incentive? I know I would like to sell it for 980, but there's not enough people, there's not enough demand in the market to buy it at 980. My incentive is to lower the price, right? Suppose I drop it to 979. The rest of the market moves with me, because then all the demand comes to me, because all the people are willing to buy at 980. Now they want to buy from me at 979. So the entire market moves to 979, and there's an increase in demand. So you're moving in this direction. So quantity demanded is going up, right? Because when you move along this curve this way, the quantity demanded is increasing. At the same time, the quantity supplied. Some people who are willing to sell at 980 will not be willing to sell at any price lower than that. So there's a decrease in quantity supply. And as the price starts to decline, we begin to converge to the equilibrium point, right? So all the excess supply goes away and the price stabilizes at $960. And this is the usual market and supply and demand dynamics. So if there is excess supply in the market, if supply exceeds demand, the market dynamics indicate that the price needs to fall in order to absorb the excess demand, and prices continue to fall as long as there is excess supply in the market. Prices will converge to a point where quantity supplied is equal to quantity demanded, and that happens when the price of the bond hits $960. Similar story here when the price of the bond is too low. Suppose the price of the bond is $950. At $950, this is the supply of the bond at D, right? Because this is the supply curve, the brown line, the red line here is the supply curve. And the quantity demanded of this bond is A, right? So there's a lot of people, there's a lot of interest in buying this bond. What is the normal intuitive thing to do? The price of this bond needs to go up, right? So when there is excess demand for the bonds, the price of the bond continues to rise till it hits equilibrium. And then once it hits equilibrium, it stabilizes at that price level. Okay. So the usual market and supply dynamics govern these movements along these curves to equilibrium. Okay. Now, the question then becomes, how does the equilibrium interest rate change in this bond market, right? So when we draw the supply and demand curves of bonds, factors other than the price of the bonds are held constant. So everything else about none of the other characteristics which determine the supply and demand of these bonds is uh, is changed. All of the other factors are held constant, right? So we'll just have movements up and down the curve. So if you're only trying to establish the relationship between price of bonds and quantity of bonds, that's just represented by movements along these supply and demand curves. So if anything other than the price of the bonds changes, right? If any other relevant variable changes, then the entire curve, either if it's a change on the demand side of the economy, then the entire demand curve for the bonds will shift. If there is a change in the supply side of the market, then the entire supply curve will shift left or right. Okay. If only the price of the bond changes, then we just have movements along the curve. So it's important to differentiate between when there is a shift in the curve in the demand or the supply curve and when there is a movement along the curve. If only the price of the bond is changing, that's represented just by movements along the curve. So if the prices goes from 980 to 960, then we're just moving along the demand curve from B to E and along the supply curve from C to E. Right? There's no shift in the curve itself. The curves are fixed in place. We just move along the curve up and down based on the price changes. But if any other relevant variable changes, which is what we'll do next, we'll talk about all the other variables which could affect the demand and supply of these bonds, then we have shifts in the entire curve. Okay. All right. So we'll treat each of these separately. First, we'll talk about the demand side of the bond market, and then we'll talk about the supply side of the bond market, right? Okay. So we'll talk about 5 factors which cause the demand curve for bonds to shift. So these are the most dominant factors which cause the demand curve for the bond market to shift. There's other factors you can consider, but for the sake of brevity of the argument, we'll focus on the big 5. The big 5 are the same as what determines portfolio choice, and that's the reason why I opened this discussion with talking about portfolio choice, because at the end of the day, what determines the demand for a bond? An investor is looking for a financial asset to put their money in. So anything that determines what goes into their portfolio, all the factors that determine what goes into their portfolio, determines the demand for the underlying assets which go into that portfolio. And these are the same 5 that we already talked about: the wealth, expected return on bonds, the risk of the bonds, the liquidity of these bonds, and the information costs associated with understanding these bonds. Okay. So let's look at a clean example. Let's talk about what happens if there's a change in wealth. So let's consider 2 cases. What happens if there's a secular increase in the wealth of investors in this market who want to buy bonds? Okay. As we've already seen, when there is an increase in wealth, there's an increase in demand for financial assets. So there's a lot more people who are willing to buy this bond at all the different price levels, right? People who are willing to buy at $980, right? Here, this is, so D1 here represents the original demand curve in this market. And now there's an increase in wealth of investors in the market. What do we expect to see? We expect a lot more people wanting to buy these bonds at this market. There's an increase in demand for these bonds at every single price level, and that's represented by a rightward shift in the demand curve. Okay, there's no change in the supply. So S here is the original supply curve. There's nothing which is affecting supply of bonds in this market. Everything here, we're just focusing on the demand side of this market. So there is investors are wealthier. They increase the demand for bonds, and that's represented by a rightward shift in the entire demand curve. So where is the new equilibrium in this market going to be? The new equilibrium in this market is where the new demand curve, D2, the shifted demand curve, is going to intersect with the original supply curve in this market, and it intersects at this point. So the market goes into equilibrium now at a higher price level. So earlier, if the market was going to equilibrium at $960 for a bond, then now the market is going to go into equilibrium at $980. right? So the first key determinant of uh, how bond prices and in turn bond yields change is to think about how demand for these bonds is changing. And one thing that could change the demand for these bonds is wealth. So as investors get wealthier, they demand more of these bonds. As there is a lot of demand in this market and supply of these bonds is not changing, the price of the bond goes up. And as the price of the bond goes up, the yield that you get on this bond falls. And intuitively, that should make complete sense, because if you look at this equation here, uh, if you look at the equation that we started with, the coupon payments stay the same. The future value of this bond is the same. Now you're buying the same cash flows, the same set of cash flows at a higher price, right? Instead of paying $960 to own these cash flows, now you're paying $980 to own these cash flows. So consequently, the yield that you get on these bonds needs to fall. So bond prices and bond yields move in opposite directions. So if you're paying more to own that bond, then the yield that you receive on that bond is much lower. Okay. Similarly, if the level of wealth of investors falls, then what we have is an opposite effect. If there's a decrease in demands for these bonds, investors are less wealthy, they have less money to buy these bonds and whatever. So we have a decrease in the demand for these bonds. That's represented by a leftward shift. So instead of from D1, we go to D3. So now the new equilibrium is determined by where the new demand curve D3 intersects with the original supply curve S. So the new equilibrium of this market is at E3, and the market goes into equilibrium at a lower price of $940, and consequently bond yields go up. So the yield that you receive, so instead of paying $960 on this bond to own this, now you're going to pay only $940 to own this bond, and consequently the bond yields go up. Okay. So when demand and supply of these demand of this bond is changing, the price of the bond is changing first. And if the price of the bond is changing, then the yield that you receive on the bond is changing. So if there's an increase in wealth, there's an increase in demand for bonds. And if the supply is not changed, then the price of the bond goes up. And if the price of the bond goes up, the yield that you receive on the bond goes down. Similarly, if there's a decrease in wealth of investors, then there's a decrease in the demand for bonds. If there's a decrease in the demand for bonds, there's a market goes into equilibrium at a lower price. If the market goes into equilibrium at a lower price, the yield that you receive on the bond is higher. Okay. The other four things, I put it in one simple table. So there's four other factors. And again, the analysis takes the same form, four other demand shifters. Expected return on bonds goes up. So if the expected return on bonds rises, then there's an increase in demand for bonds, which means that the demand curve will shift to the right, which means that the bond price will go up and the yield will fall. Okay, let me just show it to you here. Right, so if the expected returns on bonds increases, then the demand for bonds goes up and then the bond price will go up. If there is an increase in expected inflation, right? If what you expect inflation to be in the future goes up, then the real return that you get on this bond is much lower, right? And consequently, the demand for these bonds falls. So that's represented by a leftward shift in the demand curve, and which means that the market will go into equilibrium at a lower price level. Okay. Expected return on other assets, right, other than the bond that you're considering. If you're in the bond market and suppose the expected returns on equities goes up, if the expected return on other assets goes up, again bonds become less attractive, so the demand for these bonds falls. So that's represented by leftward shift in the demand curve, and then the bond price will be at a lower level, right? Because in equilibrium now the bond price will be here instead of here. Riskiness of bonds relative to other assets. If the bonds become more risky, again there's a decrease in demand for these bonds, represented by leftward shift in these bonds. Again, the converse is always true. If bonds become less risky, then there's going to be an increase in demand for bonds, and an increase in demand is represented by a rightward shift in the demand curve. Okay. So liquidity of bonds, if all else being equal, if there's an increase in the liquidity of bonds relative to other assets, then these bonds become more attractive. So there's an increase in demand for these bonds, which means there is a rightward shift in these bonds. Holding bonds is relatively more attractive. Okay, and finally, information costs relative to other assets. If it becomes cheaper, if there's an increase in how in analyzing these bonds and understanding them, there's an increase in the information costs associated with this bond. What do we expect? We expect these bonds to become less attractive. So that's represented by a decrease in demand for these bonds and a leftward shift in the entirety of the demand. Okay. Okay. So those are the factors. So these three slides here that I have are the crucial things for you to understand, right? Increase in wealth increases demand for bonds, and increase in demand is represented by a rightward shift in the demand curve. Increase in expected returns on bonds increases demand for bonds. Increase in expected inflation lowers the real return that you get on these bonds, so they become less attractive, and there's a leftward shift in these bonds. If the expected returns on other assets goes up, bonds become less attractive, so the demand curve shifts left. Riskiness of bonds goes up, again bonds become less attractive. That is represented by leftward shift in the demand curve. The liquidity of bonds goes up, that makes bonds more attractive. It's represented by rightward shift in the demand curve. And finally, if the information cost associated with bonds goes up, that makes bonds less attractive, and that's represented by a leftward shift in the demand curve. Okay? All right. Hope these things are clear. So that's basically the discussion around the demand side of the bond market, right? Again, remember, we're thinking of it as a bond as a good, which has a price in the market, a quantity in the market. There's a downward sloping demand curve and an upward sloping supply curve. The intersection of demand and supply determines equilibrium in the market and determines the equilibrium price in the market. And if you know the price in the market, you can know what the yield on that bond is right away. If only price of the bond changes, that's represented by movements along the curve. If any other factors that we discussed here, right? We've discussed 7 different factors that could change the demand for bonds. If any of those factors changes, that's represented by shifts in the demand curve. Okay? And the direction of the shift depends on whether these bonds are becoming more attractive or less attractive. Okay. So a similar discussion is in order for the supply side of this bond market. Okay. So to understand what is happening on the supply side of this market, you have to first quickly think about who's the entity, who are the entities who are supplying these bonds in the first place. These are going to be governments or firms in general, corporate bonds issued by firms. Let's say a firm like IBM wants to make an investment. They need to raise capital in order to finance these investments, and in order to get that capital, they might tap the bond market. They might issue debt. They're borrowing money. Bond is debt, right? So they want to borrow money from the market. And so what determines the supply of these bonds? It depends on what the characteristics of the firms which are issuing the bonds are, right? So there's 4 things that we might want to talk about. We want to talk about the expected profitability of these investments that the firm wants to make, business taxes, expected inflation, and government borrowing, right? These 2 things relate themselves. The first 2 things are about the corporate bond market. The fourth one is about the government borrowing, and expected inflation is the catch-all for everything else. Okay. So for instance, if you think the profitability of your investments is going up, then if you think that the return on your investments is going to go up, then it becomes more attractive to borrow money. So what do we expect to happen? The attractiveness of issuing bonds rises, right? If the expected pre-tax profitability of these investments goes up, then you might want to borrow more money. So that's represented by a rightward shift in the supply curve, because at at all price levels, now you want to issue more bonds, and that's where you see this rightward shift in the supply curve. There's nothing which is changing the demand for these bonds. So now the equilibrium in this market is going to be at the intersection of the new supply curve and the original demand curve. So at E2, which means that the price of the bond will fall because there's a lot more the supply of this bond than there is demand. Then the price of the bond will fall. If the price of the bond falls, the yield on the bond rises. Okay. Similarly, if profitability falls on these investments, if you think that these investments are not going to be as profitable as you thought, then again, there's going to be a decrease in the supply of bonds. You don't want to borrow as much money. Firms cut back on how much borrowing they want to do, which means that they issue fewer bonds. That's represented by a leftward shift in the supply curve. And now you have an equilibrium point where a new supply curve intersects with the original demand curve at a higher price. So the equilibrium is going to be at a higher price of $975. Okay. Similarly, there's the other shifters that we introduced, business taxes, right? If business taxes are raised, if the corporate tax rate goes up, then it becomes less attractive for firms to invest in these in new investments in physical capital. So they decline. So that decreases the supply of so firms want to issue fewer bonds because they don't want to borrow as much money because they're not as profitable, right? After your post-tax profitability is now lower, so that decreases the supply of bonds. Expected inflation. Now, if inflation is going up, right, then the cost, the real is nominal, the nominal rate minus inflation. So if expected inflation goes up, then it reduces the expected real interest rate because the nominal interest rate is unchanged. And if inflation is higher, then the real interest rate is lower because it's I minus inflation is what gets you to the expected real interest rate. So a lower expected real interest rate is attractive to a firm because from the firm's point of view, a lower expected real interest rate is a lower real cost of borrowing. So they might be incentivized to issue more bonds in that sense. So that increases the supply of bonds, which is represented by a rightward shift in the bond. Okay. Then the final thing is government borrowing. Okay. So in the bond market, it's not just corporate players. The government is a big player in the bond market in general. And here you see what has happened historically since 1965, right? So since 1965, so the level here is zero. So this is when the budget is balanced, right? So if it's above this line, then there's a federal budget surplus, which is to say there's the amount of tax revenues that the government is collecting is greater than the amount of government spending that the government is doing. And we've seen that the US government in particular has been running up deficit year after year for a very long period of time. So to plug these deficits, how do governments plug these shortfalls in funding? They go borrow the money. How do they borrow money? They borrow money by issuing government bonds, right? So in the last, 50 years, 1965 to 2015, the only period in which there's been a government surplus is during the late Clinton administration. Between 1997 and 99, there was actually a budget surplus where the US government had more tax revenues than what it was spending. But ever since then, again, we've reverted to the historical thing. And during the Great Recession, you see this massive increase in government um, deficits because all these relief programs that the government needed to provide in order to bail the economy out of the recession cost a lot of money, and they don't want to raise taxes during a recession, so they end up borrowing a lot of money, and you see this big ballooning up in government deficits. They've started to plug that back, but it's not really the level of deficit started to fall well until 2019 and 2020, and now again it's been a huge plunge. So if you follow this time series out, then it goes up like that, and then it again declines in 2020 because of all the relief efforts for the coronavirus. Okay, so the five things that affect the supply of these bonds is expected profitability. So if firms expect the profitability to go up, then they're incentivized to borrow more money to finance these investment opportunities, which means that there's going to be a rightward shift in the supply of bonds. If business taxes go up, that makes investments less attractive, so they don't want to borrow as much money, so that decreases the supply of bonds, a leftward shift in the supply from S1 to S2. If investment tax credits increase, right, if government is inducing firms to invest more, and they, in order to induce them, they get tax credits or for these investments, that increases again um, the supply of bonds, because it lowers the cost of investment, and in turn there is increased profitability of these investment opportunities, and so they might want to borrow more money, and that's represented again by a rightward shift in the supply curve of these bonds. Expected inflation, if expected inflation goes up, then the real cost of borrowing goes down, because real cost of borrowing is the nominal cost of borrowing minus the inflation. So if the expected inflation is going up and the nominal cost of borrowing is unchanged, then the real cost of borrowing is falling, and if the real cost of borrowing is falling, it's more attractive for these firms to issue these bonds, which means that you'll have a leftward shift in the supply curve of bonds here. And finally, government borrowing. So if government borrowing goes up, government needs to borrow money by issuing government bonds, government debt, and so you'll see an increase in the supply of these bonds at any given interest rate. Okay. All right. So that's basically covers this model of supply and demand for bonds. So we think of the bond market as consisting of the demand side of the bond market and the supply side of the market, and the equilibrium in that market, the equilibrium price of these bonds is determined by what is happening to demand, where the demand curve is at and where the supply curve is at. If anything other than the price of the bond is changing, we are going to see shifts in either the demand curve. If it's a demand shifter, then the demand curve will shift left or right. And if it's a supply shifter, then the supply curve will shift left or right. And the new equilibrium is determined by the intersection of the demand curve and the supply curve after that shift. Okay. All right. Now that we have this in hand, we can use this framework in order to talk about the bond market. We'll use this bond market model to explain changes in interest rates. We've already alluded to this briefly, but we will go in a little bit more in depth, and you can see what is happening. Okay. Right. So examples of where we use this bond market model to explain changes in interest rates, you can think about like over a business cycle, right? A business cycle very simply is that over time. So on the y-axis I have time, on the x-axis I'm measuring the growth rate in the economy. Over time, there's a long-run growth trend in the economy, but in the meantime, it's not like a linear path. It takes these cycles, right? There's periods where the economy expands, there's periods where the economy contracts, and so on and so forth. This is what we refer to as the business cycle. And during these expansionary and contractionary periods in the economy, the interest rates are going to change, and we can use the bond market model to understand how these changes. Another example where this has been widely employed is to explain the Fisher effect, right? As to how interest rates change in response to changes in the inflation rate. Okay. So let's take a look at this. When I started this discussion, I said that in response to the recession, the interest rates were cut dramatically, right? And the question then becomes, why is that the case? How can we use the bond market model to explain why interest rates fall during recessions, right? So we begin with a basic supply and demand model of the economy, the bond market model. So we have the price of bonds on the y-axis, the quantity of bonds on the x-axis. Suppose before the recession, the supply curve was at S1, so that curve, and the demand curve was at D1. Okay. And so the equilibrium in the market was established at E1, and the price of the bonds was determined to be P1. Okay. So when an economic downturn happens, that there's a contraction in the size of the economy, which means that people have less money, right? Household wealth begins to contract. As people get less wealthy, what happens? We know that as the wealth level falls, there's going to be a lower demand for financial assets. So what do we expect for that to happen? We expect the demand curve to shift to the left. Okay. So as the demand curve shifts to the left, now we have this issue where the demand curve has shifted to the left as household wealth is collapsing. At the same time, during the recession, because the economy is contracting, the expected profitability of firms is also declining. So firms are less willing to make new investments because there's so much uncertainty. The economy is collapsing, it's in a contractionary period, everything looks a little bit more gloomy. Firms don't want to invest in these newfangled business ideas or new projects at that point. They want to hold cash as much as possible. So they respond by cutting back on how much borrowing they do, which means that there is going to be a decrease in the supply of bonds. So the supply curve shifts from S1 to S2. So in the new economy, in this new paradigm, in this recession, what happens? I have a new demand curve D2. I have a new supply curve S2. What is the equilibrium in this new economy? The equilibrium is going to be at the intersection of the new demand curve D2 and the new supply curve S2, which is at this point E2, right? So the price of these bonds will go up because the price which clears this bond market is now P2. If the price goes up, what happens to the interest rate? Price and interest rates move in opposite directions. As the bond price goes up, the bond yields have to fall. And that explains why during recessions we see a decrease in interest rates, because you have a double whammy. On the one hand, household wealth is contracting. As household wealth contracts, the demand for bonds falls. So there's a leftward shift in the demand curve for bonds. At the same time, firms expectations on profitability are declining, so they cut back on how many what the quantity of bonds that they supply into the market. So the supply curve is also shifting to the left, and at the new intersection, the price of the bond goes up, and as the price of bond goes up, the interest rate on these bonds will fall. Okay, we can use the same model to explain the Fisher effect. Okay, the Fisher effect, again, remember, it's just this equation. The real interest rate is equal to the nominal interest rate I minus the expected inflation by E. Okay. So the Fisher effect says that the real interest rate, the nominal interest rate changes point for point for what happens to the expected inflation rate in order to keep the real interest rate constant. So if your real interest rate has to stay constant, if expected inflation goes up, then the nominal interest rate needs to adjust in order for that to the real interest rate to um, stay constant, right? So the Fisher effect in turn implies that when there is higher inflation, there should be higher nominal interest rates, and when there's lower expected inflation, then there should be lower nominal rates, right? So changes in expected inflation can lead to changes in nominal interest rates before a change in actual inflation occurs, right? Expectations about the future will change behavior today. That's one key thing in foundational economics that we understand, that people are not going to live in a silo and wait for inflation to kick up. They're going to change their behavior and change the demand for different types of goods and services, including bonds, based on what they expect to happen in the future. Okay, so that's what we might see. Suppose we think that there's going to be the expectation on inflation goes up. So let's start, we always start with a basic straightforward setup, D1, S1. That's the original setup. And in that setup, the market equilibrium is at E1 and the price of that bond is at P1. Now, suppose there is higher than expected inflation. If there's higher than expected inflation, right, there's again a double whammy effect. First, if you think about investors' rates of return, if inflation is higher than expected, then the real return that investors earn on these investments in bonds is going down, right? Because again, if pi e here is going up and I doesn't change, then R is coming down, which means that these bonds become less attractive to investors, and that means that you see a leftward shift in the demand for bonds. At the same time, if there is a higher than expected inflation, then on the supply side of the bond market, the real cost of borrowing, because for the people who are supplying the bonds, they are the people who are borrowing the money. So the real cost of borrowing is going down, which means that it's more attractive for them to supply bonds into the market. That's represented by a rightward shift in the supply curve. Okay. Now, the new equilibrium in this market is determined by this by the intersection of the new demand curve D2 and the new supply curve S2, which means that the equilibrium will be at E2, right? Which is that the bond prices fall, and if the bond price falls from P1 to P2, the yield on these bonds goes up. If the interest rate on the bond is going up, that's what the Fisher effect tells us, that the interest rate on these bonds needs to go up in order to compensate for the fact that there's higher than expected inflation. And we can see that clearly through this model of the bond market. Okay. All right. So to close off this section, then we'll go back to the original idea. Why are interest rates still so low, right? So if you look at this trend here, right? So here we have the corporate bond rates, right? So that's in blue. We have the 10-year treasury note rate. So that tells us what the nominal interest rate is. And this is on treasury bills. So difference between notes and bills depends on the maturity, right? A note is anything which is under, when we say T note, we are talking about maturities of under 10 years. When we're talking about T bills, we're talking about US issued government debt, which has maturity of more than 10 years. Okay. So if you look at historically, we've had very high periods of very high interest rates on corporate bonds and corporate debt and whatnot, but this has just been declining, right? And if you look at the T bills, the long dated US treasuries, that's just basically collapsed to zero. And it's never recovered since 2009, has been at zero. There's a small uptick here and that's again fallen off. Okay. And the question is, can the bond market model that we introduced explain why interest rates have stayed so low? Okay. So between 2007 and 2016, as the US government was trying to rescue the economy out of uh, the depths of the Great Recession, they tried to increase the supply of bonds. Right? They wanted to borrow more money in order to finance all these relief programs that they had. So there is an increase in supply of bonds. So in 2007, if this was a supply curve, this is where we are at in 2016. There's a rightward shift in the supply curve as the US government issued a lot more bonds in order to finance all the relief programs. At the same time, there's been a big increase in the demand for these bonds. Why is there a big increase in this demand for bonds? Firstly, there is a flight to quality. So when things become very uncertain, when the markets become very turbulent and uh, volatile, investors want to park their money in safer assets. And the safest asset that you can find is like a US Treasury bond, right? So a lot of investors want to take their money, they don't want to navigate all the riskiness and the volatility of the stock market and other asset markets. So there is a huge influx of funds into the government bond market. Okay. The second reason for why this has happened is that there is what the US Treasury did, what we call quantitative easing, where they just flooded the market with a lot of liquidity. Okay. Again, there's a purchase of long-term securities by the Fed and the other central banks. So instead of the supply, okay, so instead of the supply of bonds going up dramatically, if you see how these curves are drawn, there's a big shift. The magnitude of shift in demand for these bonds far outstrips the increase in supply of these bonds, because it's not because the supply of bonds was not uh, increased a lot more, but the point is that a lot of these new bonds that were issued were absorbed by the Fed and other central banks. So they left artificially, the supply of bonds was artificially limited in the bond market, because a lot of the government debt that was issued by the US government was gobbled up by the Federal Reserve. So they didn't leave a lot of it for the general retail market and to other investors in the economy. So there's a huge increase in demand for these products. There's not a massive increase in the supply. There's an increase in supply, but not a massive one. So in 2016, where we find ourselves is in this new equilibrium where the 2016 as 2016, they intersect here, where the price of the bonds have risen dramatically from 2007 to 2016. So as the price of these bonds have risen dramatically, what has happened to bond yields? They've fallen dramatically and they've stayed at those levels. Okay, so the simple model that we have, the simple bond market model, where all we are analyzing is the supply and demand dynamics inside this bond market, is enough for us to explain something very complicated that's happening in the economy. Okay, in the aftermath of the crisis, investors were fleeing to safety. So there's a big upsurge in demand for government bonds, for US issued government bonds. That's what we see in the rightward shift and the demand curve here. In response, in order to finance all these new relief programs that the government needed to put in place to rescue the economy, they issued a lot more bonds, but the demand for bonds far outstripped the supply of bonds. As a consequence, the price of the bonds have risen dramatically. As the price of the bonds have risen dramatically, prices and yields, interest rates move in opposite direction. The interest rates that you receive on these bonds has fallen dramatically, and that basically is what you're seeing here. Okay. So point of this exercise is to show you that whatever we're learning here, these theoretical frameworks that we're learning are, you can use them very reasonably, right? You can begin to, this is not this, I've drawn these lines because underlying this, we know the magnitudes of these shifts. Now it's a lot more complicated in the real world to understand whether we go from here to here, what's the right magnitude of the shift is a very complicated question. But assuming that this is the right magnitude of shift, we can use this model to basically analyze these kinds of events. Okay. All right. So last thing I want to talk about in this session is to talk about how the money market model and how interest rates are explained by this alternative model. So we have this bond market model. We have a second model that we often employ, which we call the money market model, and that gives us similar results. Okay. So in the money market model, we begin by thinking about the demand and supply of money. Okay. So we think about how the short-term nominal interest rate is determined by demand and supply of money. This is a model which we also refer to in the literature as a liquidity preference model. Okay. So here's the story. On the x-axis in this model, in the money market model, we are trying to look at the quantity of money. Okay, that's straightforward. On the y-axis here, we are trying to figure out what is usually on the y-axis in these supply and demand models is the price, right? What is the price of money? The price of money is the interest rate on it, right? Because if you think about it theoretically, the price of anything is what you give up in order to have it, right? The price of anything is what you have to give up in order to possess that thing. If you have to have $1 in your pocket today, you forego the interest rate that that dollar could earn. So the price of that dollar that you have in the pocket is the foregone interest rate that you could have theoretically earned had you left that dollar in your bank account, in your savings account. Okay. So there is a negative relationship between the quantity of money demanded and the interest rate. If the interest rate is really high, the quantity of money, the money demand needs to be, quantity of money demanded is low. It makes sense because the opportunity cost of holding it as cash where it's not earning that interest rate is very high. When the interest rate is high, you're losing a lot of money by keeping it as cash. But when the interest rates are really low, then the demand for money is really high because you're not losing a lot of money and people have a preference for liquidity. If you're going to give me 0.0001% interest rate for parking my money in for 2 years in your bank account, I much rather have it in the form of cash, because I much rather have the liquidity, because the cost of liquidity is marginal. It doesn't make any sense for me to park that money and not use it during that period of time. Okay. So the money demand curve slopes downward because lower nominal interest rates cause households and firms to switch to money, to switch from financial assets to money, because money is the most liquid. There's a liquidity preference in the economy. Okay. There's two key things which can shift. We talked about that equation MV equal to PY. So money demand is, remember that the quantity theory of money says that M is proportional to P times Y, right? Or MB is P times Y. So the two things that can shift money demand. So if I put a D over this, so money demand is affected by changes in real GDP, which is Y, or changes in the price level, which is the P. Okay. So if Y goes up, you can straight away see what the implications are, right? If the real GDP goes up, if the size of the economy is going up, the money demand will go up. If the money demand will go up, that's represented by a rightward shift in the money demand curve. If the price level goes up, again, the same story. Everything costs a bit more, right? Everything is a little bit more expensive. You need a little bit more money in order to buy the things that you want to buy. So money demand will go up. And that's basically what we have. Right. So increase in real GDP is going to shift the money demand curve to the right? And a decrease in real GDP will shift the money demand curve to the left. Okay. The other side of this market is money supply, right? No, so now we know what money demand is, and similar dynamics for price level. If the price level goes up, money demand will go up. So the money demand curve will shift to the right. If price level goes down, then the money demand curve will shift to the left. Okay. The other side of this money market is to think about the money supply. So the money supply is impervious to the interest rate because the money supply is determined by the Federal Reserve. Right? The Federal Reserve holds the money supply fixed, and it is the only game in town. It's the only regulatory authority which has any control over the money supply. So they can hold it fixed. They can decide what level the money supply to be. That's the reason why we have this vertical line, because money supply is not determined based on what the interest rate in the economy is. Money supply is determined independent of the interest rate. The money supply is just the Federal Reserve decides this is the amount of money supply, that's the amount of money supply. It has nothing to do with the interest rate. Okay. So here you can see what happens. Suppose this is the money demand curve in the economy, and the Fed decides to increase money supply. Right? It floods the market with more money. What happens? So the money supply curve now in the original equilibrium, the money supply curve uh, intersects with the money demand curve at this level. So this is the quantity of money which is in circulation, and the interest rate is 4%. So when the Fed increases the money supply, then the money supply curve shifts from MS1 to MS2, which means that the point of intersection, if nothing changes money demand in the meantime, the point of intersection now between these two curves is at this level, and there is a higher quantity of money in circulation, obviously, because money supply has gone up from 900 to 950, but also the interest rate will fall. Okay. So this money market model again tells us how the benchmark nominal interest rate in the economy moves around in response to changes in money demand and money supply. Okay. So here are the three things that determine what the level of what the nominal interest rate in the economy will be. Real GDP. If the size of the economy goes up, there's an increase in real GDP, then there's an increase in money demand. So the money demand curve shifts to the right. If the money demand curve shifts to the right and money supply stays at the same level as it was, the nominal interest rate in the economy will go up. Price level, same effect. Price level goes up, people need more money in order to buy the things that they were buying before. So the money demand curve will shift to the right. And if the money supply is held fixed, then the nominal interest rate will go up. Money supply, on the other hand, if that's increased, then there is more money in the system. And if money demand is not changed, then you'll see a decrease in the nominal interest rate. Okay. So that basically covers this entire discussion around what determines interest rate. So we opened this chapter with a question of how is an interest rate determined in the economy? Okay. So we have two competing models, two alternative models. They're not competing models precisely. It depends on what it is that you're trying to analyze. The first model treats bonds as a good. So there's a demand for bonds, there's a supply for bonds. There's things that can shift the demand for bonds. There are factors that can shift the supply for bonds. Depending on what is happening there, we determine the new equilibrium. In the new equilibrium, there's a new price for these bonds, and based on the new price for the bonds, the bond interest rate is going to rise up or down. The second model that we discussed is on money market. So there's a demand for money based on liquidity preferences. There's a supply of money, which is inelastic, which is to say it's determined by the Federal Reserve. And now, depending on whether the money supply is increased or decreased, or whether real GDP or price level in the economy is changed, which affects money demand, you will see changes in interest rates. And that basically tells us how these different interest rates are determined inside this economy. Okay. So that's basically all I want to do for this section. So again, if there's any questions, please let me know in the comments below the video, or see me in an office hours on Friday. I'm happy to help. But that's basically it for this session. Thanks so much for listening, and I'll see you in the next one.